Alright, so you guys know that Bigfoot has a picture of Jim Morrison? Alright, so today what we're going to do investing. We're going to do a particular type of investing. We're going to do investing in mutual funds. I pick mutual funds because if they're not the most popular form of investments, they're definitely one of the most popular form of investments that people are buying today. They would take a typical person who's saving for retirement. What they're probably doing is investing in mutual funds. Mutual funds 101. If you want to know about mutual funds. What are mutual funds? Anybody know? Do you have a guess what a mutual fund is? Yes.
The act of giving money to a government or company, or lending money.
What a mutual fund is they're run by what they call a fund company, like American Funds, Fidelity, Janus Funds. And basically what they do is they buy a bunch of different stocks and bonds and put them into one fund that you can invest in. You can buy and sell mutual funds just like you can stocks and bonds. You buy them on shares. So each share has a price. Just like a stock, just like stocks do. The benefits. Why do people buy mutual funds rather than individual stocks or bonds? Well, one of the main reasons is that mutual fund has a person they have called a fund manager who runs the fund. And then they have people working for them called financial analysts. And these guys are professional financial people. And what they do, they research the company, they research the stocks, they make the picks for you. So A, you have a professional picking the stocks for you, and B, most people are working or going to school or real busy, you don't have to spend the time researching the company and make the stock pick yourself. So another reason is because it's an amalgamation of stocks and bonds, that fund's already diversified. Because you're investing anywhere from say 10 to 100 different companies in that mutual fund. So what that does, that lowers the risk of you losing your money when you buy into that fund. Because if you're invested in 10 companies, when the company goes broke, the stock that you bought in that company is now worthless, but you still invested in many other companies that can make up for the loss. This makes it a good investment vehicle for people who are saving for retirement. So you look at a lot of 401ks, a lot of IRAs, a lot of people have mutual funds. You have drawbacks to it. First drawback is they trade differently than stocks do. It's a little hard to, this concept's a little hard to explain, but say you have a stock in Apple computers, and you bought it for $50 a share, and you notice that one day it's up to $100 a share. Well, you can call your broker or do it online. You can do it by yourself and put in a sell order to sell that stock at $100 a share. So when you do that, that order is executed immediately. You doubled your money. Mutual funds are sold at the end of the day, end of the business day on Wall Street, which is 5 o'clock in New York, 2 o'clock here. And guys, the problem is there's a lot of stuff that can happen on Wall Street per day. October 17th, 2008, the stock market fell 800 points in a day. So you run the chance of not getting the price that you want when you sell your mutual fund. The initial purchase fees, usually from 2 to 5% of total investment. So this is what you pay the fund company to invest your money for you. That's how the fund company makes their money. So if you want to invest in a mutual fund, you have $1,000 to invest, and you have a 3% fee. Basically, they take $30 of your money right off the top. Instead of having $1,000 invested, you have $970 invested. So it costs you a little bit of money to invest in a mutual fund. You tend to have lower return rates than just buying individual stocks, and that's one of the things, just because it's diversified, they're less risky. Not all the stocks and bonds and mutual funds are going to perform well for you on any given basis. Minimum investment, anywhere from $250 to $2,500 on average. Typically, if you want to buy a mutual fund, you're going to have $1,000. That's kind of the rule of thumb. Take a look at the low end. Waddell & Reed has mutual funds that you can get into for $250. That's probably the lowest initial investment that I know of. Fidelity funds, have you guys seen the commercial? You know, follow the green line towards retirement. Fidelity, what they leave off the commercial is that the minimum investment is $2,500. So if you don't have $2,500, you can't buy that Fidelity. Risk. Anybody know what risk is? Risk, well, risk in the finance world is the odds that you're going to lose some or all of your money. So basically, anytime you invest, there's two different kinds of investments, called fixed investment and variable investment. You take a CD from a bank, you buy the CD from a bank, the bank says, I'm going to pay you 2% guaranteed no matter what happens. That's a fixed investment. You're going to make that, no matter what happens, you're going to pay that back later. So actually what they call variable investments would be they go up and down. So anytime you buy a variable investment, stock, bond, whatever, you take the chance you're going to lose some money. Rule of thumb, the greater the risk, the greater the return. So the more risky the investment, the more money you can make. It's a rule of thumb because it's not set in stone, guys. Because you can have a very risky investment and not make a lot of money on it. But that's kind of the general rule of thumb. So here's your particular investments. This is the amount of risk that you're facing. This is your return. CDs, your certificate of deposits, they run from 1 to 3% return. Very low risk because you're guaranteed to get that return. Bonds are very low risk because you're guaranteed to get the return unless that company goes out of business where you bought the bonds from. Right now they're running between 3 and 6% returns. Stocks, more risk because stock price is going to fluctuate on you. But hopefully the company that you purchased doesn't go out of business and the stock goes down to zero. That runs typically right now 6 to 12% is a good return for stocks. And then you get into betting on futures, commodities, and options. Pretty hard to explain that kind of stuff. We're not going to go over it. But you can have some real risky investments where you can be a millionaire one day and broke the next. I've seen it happen. The most famous company is a company called Enron. Who's heard of Enron? Enron's called the Crooked E. It was an energy company down in Houston, Texas. And what they did is they funded their employees' retirement accounts with the company's stock. And they went out of business. So you had people who were literally millionaire executives one day, broke and unemployed the next, because they had all their retirement savings in Enron stock. Enron went out of business as stocks were zero. Diversification. What's diversification, guys?
Essentially, just spread out.
Spread out your investments, different companies, different industrial sectors. So if one thing goes bad, not everything's going to go bad. You've heard that expression, don't put all your eggs in one basket. But what does that really mean? It means by buying different investments in different industries, you lower your risk. I like to use what I call the window pane analogy. So basically you have two types of windows. Your portfolio is a single window, like that window there. Somebody comes by, throws a rock through that window, the whole window's going to shatter. You have a window pane, like that window there. Somebody comes by, throws a rock through the window, one pane shatters, but the rest of the panes stay intact. Okay, any questions on the basics of mutual funds so far, guys? All right, so you got some money, you want to invest it, you want to buy a mutual fund, but how do you pick a mutual fund? Right? Even if you have a broker, you have to be savvy to know that what the broker's telling you is a good investment. So everybody turn on their monitors and get on the internet for me. It'll take a minute to do that. So one of the really good investment tools out there is on the internet. It's called Yahoo Finance. And it's free. It's not going to cost you anything to use it. Which is good because you don't want to keep the costs down because you want to make money, not spend money, right? So I want everybody to go to www.yahoofinance.com. www.yahoo.finance.com. Yahoo.finance.com.
Finance.com.
That will work too. And you see, everybody should have a page that has like a picture of a bull on it.
You guys might want to go to Google and go in that way. Sometimes when you put it in the URL, it takes a while.
Put in the URL, Google will block it. By the way, does anybody know the difference between a bullish market and bearish market? Because you hear the Wall Street get bulls and bears. What's the difference? Anybody know? Right now we have a bullish market, which means the market's going up. In 2008 we had a bearish market, which means the market's going down. Take your mouse, put it over investing. Brings up a whole bunch of different options, all the different things that you can invest in. You can invest in anything pretty much. You go down, click on mutual funds. It's going to show you all the mutual funds out there. Guys, there are thousands of different mutual funds. You can invest in anything and you can invest in everything. Once had a client buy a mutual fund that was a NASCAR fund. All the companies in the fund are part of NASCAR in some way or another. Okay. We clicked on mutual funds. So right on top, you should see a fund called ProFunds Biotechnology Ultra Sector Service. Can anybody give me the rate of return? 3 months. 37.6%, right? Guys, that's a good paying fund. Translate that into money. January 1st, you took $1,000 and put it in that fund. Today you'd have $1,370.60. You'll see the clicker, you'll see what they call the code or the ticker, BIPSX. Every mutual fund, every company that sells stocks has a code or a ticker. They do this because it's easier to tell your broker you want to buy 10 shares of BIPSX rather than 10 shares of ProFunds Biotechnology Ultra Sector Service. That's why everybody has a code. So ProFunds right here, anybody know what that means? ProFunds is the name of the fund company that produces that mutual fund. Usually when you look at a mutual fund, the first word in it is going to be the name of the company that produces that mutual fund. So I want everybody to click on BIPSX. What that's going to do, that's going to bring up the stats on that particular mutual fund. But this is where you can look at the fund and say, hey, do I want to invest in this or not? So any questions so far? Everybody got that fund up? Alright. So basically, when you want to invest in a mutual fund, you want to take a look at the stats. You want to see how that fund's doing. You want to make sure it's a good investment. You don't want to lose your money. You want to make money, right? Right on top, you'll see a big number. It's cost per share. Yesterday it was $122.97 per share, which means if you buy one share in that mutual fund, it's going to cost you $122.97. What's the cost per share right now? $128.64. So if you had this mutual fund yesterday, you had 10,000 shares of this mutual fund yesterday, and you sold it today, you'd make $600. Year-to-date return also will be under a 3-month return. There's a 37.06%. That's a high rate of return, guys. It's a good producing fund. Net assets, $167.68 million. That's how much money is invested in this fund. You'll see funds, some funds, older funds, more traditional funds, might have $3, $4, $5 billion in this. A lot of money. But that's how much money people have invested in this fund. This is actually a relatively small fund. You have a chart, top left-hand side. The chart goes like this.